And good morning, and welcome to another episode of Money Matters. My name is Nev, and I am beyond excited that you are here so that we can talk about what's going on in the world of money, investing, business, finance, and really find ways of how we can protect ourselves and potentially prosper during this time. This is broadcast live every morning at 7 a.m. only on onedealaway.com/live. And if you're watching this on YouTube, congratulations and welcome to my channel. Thank you very much for joining, finding the video, and if you could do me a favor, do hit a like or thumbs up button. It does help quite a bit, and it helps me get more people into the channel to help them learn, to help them prosper, to help them take care of stuff. So today we have very, very important concept of all kinds of things that we got to cover and talk about, anywhere from what's going on with our money, what is the fraud. I mean, today's episode really is all about what's going on with the tariffs and boycotts and theft, and we're seeing all kinds of things that are happening around the world, in United States, in other countries, from Europe to China to everywhere else. And we're going to talk about a little bit about what happened with the markets, what can you expect, and how else can you potentially save money if we're thinking about not saving fiat. All of those things and so much more coming right up. Let's do this. And good morning and welcome. It is Friday, June 26th. I had to check, sorry. And today we're going to cover some of the pieces of what's going on with the markets, with the economy, and what you can expect. We're also going to talk about the velocity of money because we already talked about that whole concept when we talked about how Fed is switching in one of the previous episodes earlier this week. We talked about how Fed is switching on their strategy and where their money is actually going. They're going from funding assets to actually funding spending. And that has a much greater and potentially graver conversation about whether we will hit out of the depression level all the way into the inflation or potentially hyperinflation. And for that, we do need to understand what's going on with the velocity of money. So here I have a chart for you directly from the Federal Reserve. This is from Fred in St. Louis. And you can see right over here, the chart. This is the velocity of money. Now, velocity of money, in case you missed one of the previous episodes or don't understand what it is basically how quickly does money change hands. It's sort of like when I earn $10 and I go to the gas station, I fill up my car with the gas. That gas station gets at $10. Then the gas station owner goes and spends it over to the gas company. The gas company pays their employee. The employee pays for their food and the rent. And so this money kind of changes hands. So the velocity of money basically monitors how quickly does this money change hands. When we see the change of hands happening quite a bit and we see a lot of money slushing around, we experience a much higher inflation. Now, when it actually starts slowing down, we start seeing deflation, and that is actually where we are right now, and that is what the central banks around the world are attempting to fight against, because all of the fiat currency is built on inflationary forces, not deflationary forces, and so it's highly problematic. Now, why is that? Well, because money, the way that it's created, the thing that we call money, the fiat currency, right? The dollar, the euro, the yen, the renminbi, the whatever, right? Whatever currency you have in your country, all of that is basically created, quote unquote, out of thin air. It's borrowed into the existence, if you really think about it. So with that in mind, we understand that the money is debt and a lot of it is being borrowed. Well, if it's deflationary, that means that it becomes a bit more expensive to pay the debt off. Inflation means that inflation actually eats quite a bit of that debt, especially if it's long term, especially when it's fixed rate. And so it helps with the ability to keep borrowing, which can keep on growing the economy. And as you know now, and as you're going to discover in today's episode of what things that we're going to talk about, we're not necessarily growing. We'll be shrinking. We'll be shrinking well over 8% as they're predicting in United States. And in first quarter, we shrunk about 5% or so. So right over here, what you're seeing is the velocity of money. And the gray areas that you're seeing, this gray sort of vertical bars, those are the recessions that we have experienced. And it goes all the way from, it looks like the 1960s, maybe a little bit before then. And you can see that we had all of these different recessions that are going on. And you can see that we sort of peaked in, it looks like in 97 when it came to velocity of money. And we have been in an actual downtrend. Now, it goes a little bit up and down. It's cyclical like everything else. But you can see that it is severely going down. And here we are in first quarter, right where the mouse is. That's the first quarter of 2019. And since then, look, it's just gone straight down. So looking at this, now, of course, this lags a little bit, right? And it only shows us the first quarter of 2020 because we are in the second quarter of 2020. So they can't tell us what's going on now. All of this is sort of a bit historical in view. So it doesn't predict where things are going to go. It only showcases of where we are going, where we are heading. And talking about where are we going and where are we heading and what's going on, let's take a look very briefly of what's going on within the world of stock market. Now, stock market used to be very much connected to the economy. Now we can all agree that that is no longer the case. It's decoupled in a big way. But let's take a very quick sort of news from Yahoo Finance of what's going on with the market news, and it's saying sort of live updates, and it's live-ish as of like late last night. But the stocks rose heading into the market close on Thursday with financials leading. And the reason financials were leading is because the Fed eased even more regulations for the banks, allowing them to start putting money towards the venture capital funds, VC funds. So, and in a world of business, VC funds are also known as vulture funds because oftentimes they will take a large chunk of the business and of the returns and of everything else. And their overall goal is to try to find startup companies to pump the money in it and, hope that they will benefit in a great way if and when the company thrives and goes public. Some of those, vast majority of the companies that you know and potentially even love have been backed by the VCs for many years. One of those is Wirecard, which has been funded by the SoftBank. And we're going to talk a little bit more in a few moments about Wirecard and what's going on with them. And we're also going to be touch on SoftBank and kind of, their decision-making skills and strategies. Now, stocks traded choppily after Texas said it was pausing its reopening process because of the surge of COVID-19 in Texas, amongst other states. We are seeing that reopening is actually slowing down with closing, with additional quarantines. And so there's all kinds of additional problems that are being created as we speak. New unemployment claim came at 1.48 million yesterday was announced for the week ending June 20th. Again, all of the stuff that we're getting is historical because they have to get the data. And please keep in mind that this is an estimate. It's not actual. And keep in mind also, we've covered it on this channel, and I'm sure that there's other channels that are covering it as well. When they report some of the stuff, it's not 100% accurate because of the way that they collect information. They do know that there is a large discrepancy from actual to reported. So keep in mind that that's not the actual number. Now we are looking at, about 40 some million people that are still unemployed. Jobless claims are not falling fast enough, and the phase four of fiscal stimulus must be bigger. This is coming out of head economics at Renaissance Macro Research, and they are basically saying things should get better in about a month, but the news will get much worse before it gets better. Now, I don't know where exactly they're getting information that things are going to get better in about a month, because as we know that a lot of these programs that were rolled out in March when the pandemic hit hard for the first time around are set to expire in about a month from now. For example, the forbearance, the unemployment additional pay, and a slew of other programs that are basically set up to help, and the additional stuff like the phase three, phase four, phase whatever. They're giving it all these fancy names. I can't keep up with it. But basically, the next round of stimulus that is set to potentially help and assist and maybe extend the unemployment benefits. They haven't decided anything. They have been sitting on it. And as we know, once we hit into the July, these folks go on vacation, you know? Like I said, they're like 3-year-old kids. They need their Reese's, they need their lunch, they need their Scooby Doo snacks. So, it's going to be interesting. And I think something additional will come. We just don't know what exactly that is going to be. We don't know what it's going to look like. And my fear is that they will come a bit too late to the party. So that means that folks that are first to sort of expire with some of the stuff are going to experience some rather painful times, and that will have a very grave impact on economy and on the markets. And when I talk about the markets, I'm talking about the stock market, the bond market, which might be a little bit reversed, potentially gold, which actually could boost it up, cryptocurrencies, again, it could boost it up. Real estate could potentially go down in price. So it is going to be interesting for sure. Now, states in the South and West reported more increase in the new coronavirus cases. California reported more than 7,100 new cases, a one-day record by far for the state, while Florida and Texas also reported record jumps in new cases at more than 5,500 each as of Wednesday counts. New York, New Jersey, Connecticut called for a 14-day quarantine for visitors traveling from many of the states. Now, this is an interesting piece, and we're seeing actually more states starting to worry about and prepare for that kind of closure and that kind of call. Now, here, as you know, we're broadcasting live every morning on onedealaway.com, and we're doing so from Providence, live from Providence, Rhode Island, which, like I said, for those international viewers, some people have called us the suburbs of Boston. While it's not exactly suburbs, Boston is the closest larger town that you might be a bit more familiar with, since Providence is much, much smaller place. And I like it that way. But one of the interesting pieces is that we here in Rhode Island do have a bit of that 14-day quarantine for all the states and locations that have stay-at-home order, but we don't have anything for these states that are seeing spikes. However, the government is talking about it, and in my conversations and counseling with many businesses around here, they're all looking for ways of how they can protect themselves within this particular realm. And so I think it's going to be interesting. And I think this is going to have a bit of a negative or a downward threat or spiral towards the economies and, of course, businesses, because this affects the business. Economy is just basically collab of all of the businesses that are in it. And so I think that there's definitely something to this to pay attention to. Now, International Monetary Fund on Wednesday slashed its outlook for 2020 global growth to a record low estimate of negative 4.9%, which is down from April estimate of negative 3%. U.S. global growth is expected to fall by 8% in 2020, down from previous forecast of 5.9%, while before rising by 4.5% in 2021. Again, we did cover this. We did talk about this stuff. So it shouldn't be a surprise to any of the viewers that have been sort of tuned in to what we have been covering and what we expect to be going on in the world of money. Now, I want to make sure we take a look quickly at what's going on within the stock markets and the indexes. And this is the part we talked about how Thursday sort of closed on up. And you can see this is Russell 2000. You can kind of see that right around 2:30 p.m. It did actually go on up. In the 5 day, well, we are still down. Let's take a look at gold. Now, gold is an interesting one. Of course, it kind of trades a little bit differently. So you can see it was sort of sideways-ish, but let's take a much bigger picture. And on a bigger picture, 6 months or 1 year even, it is a very clear, very slow, but very clear upward cycle. Now, let's take a look at NASDAQ. NASDAQ also did close up yesterday in a 5 day. We did have a nice bump on Tuesday, dropped down on Thursday, and we're sort of trying to kind of climb out of it. Dow Jones Industrial, same story. On a 5 day, they are down, and S&P 500, again, they were nicely going up for the day yesterday. However, they are down in the course of 5 days. So there you go. That's kind of what's going on within the traditional markets. Now, I do want to switch very quickly on what's going on in the world of crypto, and I'm just trying to adjust so that you can see the charts as well. So here we go. You can see that Bitcoin is slightly down. We actually have gone down about $300-400 from the previous high of a couple of days ago, where we were at about 95, 9600. Again, this is one of those things that I have been talking about, that we're going to be bouncing between, I would say, 8800 to about 1100, maybe 1200. I think we're going to see a bit of a bounce within this particular market. When we look at a 24-hour change, the top gainers are, it's so interesting. See, they're putting Loopring on the top, even though UMA has put in 12.1%, the compound is up by 10.5%. So I'm not necessarily understanding how or why this happened. And I'm using CoinGecko this time around. Typically, I use CoinMarketCap, but I wanted to change to CoinGecko just to get a bit different perspective, because we understand that everybody's using different exchanges. And so that's the nice part about the crypto, that there are different exchanges and you have ability to sort of have an arbitrage when you switch from exchange to exchange, to be able to actually make money just by switching exchanges. So, but it's interesting kind of how they're putting this in. I would expect that they would have done it by the top to the bottom. Okay, it seems like they're working on the way down, sort of, not really, no, just kidding, because Balancer we have at 12, Bancor Network token is -9, AVE is -7, Verge is -8, but it's below AVE. So I don't know. I don't know if they're taking market cap. They're not. Okay, I can't explain it. I don't understand it. My apologies. But we can see that we are seeing some coins definitely hitting a bit higher down market pace. So it is one of those pieces to always keep in mind and always pay attention to what is going on. So now I actually want to go in and talk a little bit about what's going on in the world of business. And today's conversation is going to be a bit on Facebook, and it's also going to be on Wirecard. So let's get started with the Facebook. And first, I want to do a briefly sort of what's going on in the Wall Street Journal. As you can see, there's all kinds of news happening within the business that there's no way for us to cover this stuff, because I would have to go live 24/7, 365, and even then we would still miss vast majority of the news. So it's important for you to continue to watch the channels, watch the different news, and follow channels that make sense. Now, one of the things that is interesting is small business race to spend PPP funds, but pandemic drags on. So they are struggling with spending the money that they have to spend. But here is the piece that I wanted to talk about, and that is the Facebook looks to contain advertising boycott over hate speech. So here is what's sort of going on. Now, Facebook is actually, there's companies that have decided to boycott Facebook by suspending ads on Facebook accounts, or suspending their Facebook account ad accounts, because of the sort of fight to say, you know what, the Anti-Defamation League, the NAACP, Sleepy Giants, Color for Change, Free Press, and Common Sense basically decided to ask all of the large companies to boycott Facebook to basically help stop and prevent racist, violent, and verifiably false content to run rampant on its platform. And so companies like REI, the North Face, Patagonia have decided to basically stop advertising on Facebook for month of July. Now, they're not going to stop for forever, at least not right now that the folks are talking about, but they're saying they are pulling ads from Facebook and Instagram for month of July. North Face also decided to join this group, as did Upwork. The CMO of password management company Dashlane, Joy Howard, said in a blog that the company would also be stopping all paid organic posts on Facebook and Instagram through July. And there are many ad agencies. One of them is 360i, who is urging and telling its clients to basically they're supporting the boycott for July and asking their large clients to also support it. We did see news yesterday that Verizon also decided to put a pause on their advertisement from it, and I'm sure that there's going to be many more businesses that will come in. Now, the Facebook stock price yesterday, well, it didn't do much of anything. I mean, it was fine on the 5 day. It's actually slightly negative in a 1 month. It's actually on the positive as it's in a 1 year. You can actually see it right here. It's chugging right along. So clearly, the customers and the holders, the shareholders of Facebook really could care less. And Fortune magazine does say that the Facebook ad boycott is not going to change anything for the company financially. What they're saying basically is that there's well over 8 million advertisers on Facebook. And if you have a handful of them sort of stop, yeah, the company kind of feels it, but it's not going to bankrupt them. So more than 10 companies, REI, Patagonia, Unilever, Ben& and Jerry's, have joined the campaign of basically saying we're not going to support this. And a large outcry also came after President Trump's certain statements that kind of raised some political and social questions of, are we going to check him? Are we going to sort of stop him? And so there's the people basically saying, you know what, we want you to change stuff, and we are going to vote with our dollars, so to speak. Now, they're saying, the Fortune magazine is saying that the impact on Facebook's revenue is expected to be limited if there's any impact at all. Companies that join the movement will likely have a very tough decision to make in August when the boycott is supposed to end. If Facebook makes no incremental changes, it is quite curious to see what the brands end up doing, what their next move is. If they just switch the ads back on, then they're basically being disingenuous and sort of lying. If they don't and they're willing to hold out, well, then it can actually become much more interesting. And so it's going to basically be seen. Now, one of the pieces that the writer of the article is saying, this is not the first time that advertisers are quote unquote boycotting Facebook, and it's always caused very little change or very little negative impact on Facebook. And typically they either lose revenue or they come back. So it's definitely one of those, I think, PR moves potentially that they are doing, but not much. There's not much expectation of what could potentially happen. Now, one of the other pieces that I wanted to talk about is not necessarily boycott per se, but it has more to do with, fraud, which is Wirecard. Now, Wirecard is a European-based company that provides credit card services for different companies. Now, we're going to switch over to the world of crypto because one of the, while crypto.com is not the only company that is using Wirecard, they are one of the more prominent ones that many people have been watching. And so we're going to use this point to talk about both the crypto.com as well as Wirecard, as well as why you, as a consumer, as an investor, should be paying attention to a third party risk. Now, third party risk, let me explain that very briefly before we go on. Third party risk basically means that when we invest in something, of course, there's a first party risk, which is me. There's a second party risk, which is the company that kind of we're dealing with. And then there's a third party risk, which is all these side components that are happening. So, for example, if I end up doing business with crypto.com and I end up getting their crypto backed card, there is a risk that crypto.com might sort of do something disgenuine, go out of business, right? That there's going to be some sort of problem there. However, because they're using Wirecard as their card provider, that's a third party risk that we're experiencing right now. So, this is very important for you as a business owner, but also you as an investor to understand what risks you take when you invest, whether that is in the crypto based projects through the tokens and cryptocurrencies, or you are investing as a private equity holder, or you're investing in traditional stock markets where you're holding basically either preferred or common stock for the business. Okay, so Wirecard subsidiary that is responsible for issuing debit cards has been suspended as the company can no longer access customer funds. A statement issued today on June 26 by the regular Wirecard subsidiary is required to do not dispose of any of its funds, stop conducting any of its regulated activity, and it must communicate on its website and to its customers that it is no longer permitted to conduct regular activity. As of press time, which was only a few minutes ago, such statements are not present on any of Wirecard's websites, including the subsidiary dedicated domain. The 1.9 billion euro shortfall in Wirecard is what basically causing the stop. On Friday, regulator took additional measures and forced the firm to stop all regular activities, and this now means customers' money cannot be accessed, the statement concluded. The customers may be barred from using any of the debit card issued by the company. That includes crypto debit cards from Crypto.com, 10x, and others. CEO of Crypto.com, Chris Marszalek, hopefully I have pronounced that correctly, and if I haven't, my sincere apologies, reassured his customers that funds are secure and are owned by the company. As of this moment, the cards are working fine. We will rapidly proceed to credit the funds back to our users in case of disruption, and given the announcement made by the FCA today, this is highly likely. The company is looking for alternative solutions to ensure customers can continue using their cards. Now, the scandal, of course, is developing and growing. Wirecard woes began when the company admitted to lacking over 32% of its claimed assets, which was worth $2.1 billion. They were basically being audited by Ernst& Young, I believe, and I have discovered the discrepancy. Of course, it hit the news. The CEO has resigned, has then been arrested by the authorities. I believe that he's out on bail right now. And yesterday, or on Thursday, the company has filed for insolvency in Berlin, and due to the sudden shortfall, which is typically a first step to bankruptcy. Now, an interesting piece to pay attention and understand about the Wirecard is the fact that it was backed by SoftBank. Now, one of the interesting pieces that I wanted to use this to talk about the SoftBank as well is that it's been very interesting of whom and how they have been backing companies. You will recall that only a few short months prior to the pandemic and us switching topics to talk about health benefits or lack thereof for everybody, SoftBank was doing business with WeWork. Remember that? And there was a giant scandal with WeWork. So that was kind of pulled and backed out. There was another one with Uber. Now, Uber doesn't have as many scandals that I know of, but if I do, let me know in the chat of, if I am missing stuff, or in the comments if you're watching this on the replay. And by the way, if you're watching the replay on YouTube, do me a huge favor, hit the like button. It does help spread the news around the world and access more people. And do subscribe to the channel, and hit the bell button if you want to receive daily notifications, because we do go live every single day. And when I'm unable to do this, I plan in advance whenever possible, and I prepare a video for you. So every day you receive a brand new video, whether it's going about the news or education about different concepts when it comes to investing and protecting your money, as well as potentially prospering during these and any other times for that matter. So SoftBank basically has been making some very questionable choices and decisions that now is making me think twice about them as an investment company, as an investment vehicle. As you know, you have an ability to invest in SoftBank, but for me, they're becoming a bit too risky to want to do any sort of business. And until they kind of clear things up, I don't know that I want to invest with them. Not that I have, not that I own it, and of course, not a financial advice, just my personal opinion as I'm looking at this stuff and going, wait a minute, there's a pattern here, and I want to look for patterns to protect myself. And the reason I use them is to also point out the patterns so that you too can start paying more attention to the patterns. Now, we did talk about I did promise that we're going to talk about sort of the depression-like crisis and what's going on and unfolding. And we do have an article today, just like usual, to talk about different things. Now, there is a depression-like crisis and the no V-shaped recovery until 2023, UCLA Anderson warns. So I have been talking about the fact that we are entering depression. We have entered depression. There will be no V-shaped recovery. And so here is another sort of article from an independent third party that is talking about similar things. Now, the virus pandemic has morphed into a depression-like crisis with no V-shaped recovery until 2023. We are forecasting a 42% annual rate of decline in real GDP for the current quarter. Now, the real GDP will decline by 8.6% in 2020. This is very similar to what IMF had stated. If you remember, only a few minutes ago, I have shared that IMF said that real GDP for US for 2020 will go down 8%. They're saying 8.6. That's pretty dang close. Now, then they're saying, of course, it's going to increase by 5.3 and 4.9 in 21 and 22, respectively. The labor market might not recover until well past 2022. And they're saying unemployment rate will stay well over 10% for that period of time. The economy is in desperate need of more stimulus via the Federal Reserve. And I have been actually talking about it and asking and calling for it. Of course, I don't have that kind of power to make it, but I'm just looking at stuff and saying they're going to have to do it. Now, will they actually do it? Will they not do it? I don't know. But I do fear that if nothing is being done, more people will suffer. And I think more people will hit the streets, and we will see more uprising, more riots, more protests, and more disturbance and potentially even violence. Again, I hope we don't come there, but anything is possible. When people get desperate and sort of, don't have anything to lose, they lose it a little bit, as Gerald Salenta will say. Desperate, despite the Paycheck Protection Program, too many small businesses will fail, and millions of jobs in restaurants and personal service firms will disappear in the short run. The report says the economy has hit bottom. That doesn't necessarily mean GDP and employment levels will immediately surge back. And this is sort of talking about the restaurant seat occupancy. And you will see kind of this is the baseline, and this is kind of where we're starting to go. And you can see that it's sort of by state, Okay. Now you say the retail sales for restaurants have yet to bounce. So here is the retail. It's dropped severely, kind of a slight uptick, but not much happening. Industrial production remains at lows. You can see the industrial production right here. Okay. Explosion in government debt. Well, that has gone up, right? Which is used to prop the economy. And so this is the government debt. This is the sort of the tax. U.S. continuation jobless claims. You can see we kind of hit the high, and it's sort of like tapering off, and it's kind of, looks like it's not, it didn't go up and down. It went up, sort of down, and now it's going sideways. That is highly problematic. Biblical wave of bankruptcies is about to flood the U.S. economy, and they're expecting that the delinquencies of the banks are going to basically start going through the roof. We have seen quite a bit of bankruptcies already hitting stuff. The retailers were one of the first ones, and they're saying we're going to expect a whole lot more coming to the town and state near you, and maybe even country near you, for way more. And I am expecting that to be in the fall into winter, potentially spring for those that can kind of hold on for a little while longer. The stock market, disconnected from reality, is setting up for the next possible stock market correction. And so you can see right here that you have the Dow, which has gone down, and then sort of started to go up. And you can see that they're very connected. I mean, they're not 100%, but there's a strong correlation that they kind of have to go in unison. What we have seen from March is that you have the sort of the economy kind of going down and the market going up, and we're seeing this. Sometimes they call it like the alligator jaw, where it kind of like opens up. So that's one way to sort of look at it. The other way to look at it, I believe that this is called the megaphone pattern in the world of trading. And that one is very, very weird to trade. If this was a stock, this would be a really weird one to trade. But I think alligator pattern is much better because you have one sort of index or whatever you're measuring here, and then the other one here. And what happens when the alligator opens its mouth wide? Well, eventually it's going to have to close it. So, and when it does, that typically does not end up rather nicely for anybody who is inside the jaws. So you want to get out is basically what they're saying. Corporate profits are sliding in alligator jaws, right? So there you go. They're calling it right over here, and you can kind of see what's going on. Now, the UCLA Anderson forecast new downward revision of the recovery suggests the worst has yet to be seen. Several more years of pain are likely ahead. So as you can see, they are calling for a bit more painful and a bit more different expectation of where we think we might be going, what we could expect to see. The final piece that I want to end with is sort of what's going on with our savings and how potentially cryptocurrencies and decentralized finance could help us. So let's talk about that. Okay. So here's the article that is talking about you don't have savings account, you have a dwindling account. Very, very interesting. Now, on April 5th, 1933, President Franklin Delano Roosevelt signed an executive order which outlawed the private ownership of gold. FDR used wartime authorities under the Trading with the Enemy Act of 1917 to basically do this. All Americans must surrender their gold to Federal Reserve Bank by May 1st, 1933, so less than a month from the executive order being signed. Gold was a popular form of savings at the time, and those that failed to comply faced up to 10 years in prison and $10,000 fine, which was a huge sum at that time. I mean, think about it. This is the 30s, right? So we're talking like 70 years. The government actually prosecuted people who refused to turn their gold, and people who did comply with the order, the government paid $20.67 for every ounce of gold. Once after they have collected all of the money, the Roosevelt raised the price of gold to $35 per ounce, essentially stealing money, stealing nearly half of wealth for those who were gold owners. It wasn't until 1970s, so about 40 years later, that gold ownership was once again legal. In 1971, Nixon entirely divorced dollar from the gold standard, and that's where we entered. The dollar entered completely new fiscal or currency. We became full fiat currency at that time, as did the rest of the world. The rest of the world very much followed. Throughout the next decade, in the 70s, the US and much of the world was hit by terrible stagflation. High unemployment, high inflation, high taxes, high debt level, and no economic growth. Adjusted for inflation, the Jones Industrial Average lost nearly half of its value during the 1970s. Government bonds paid just 5.5% at the time when the inflation peaked at 10%. Now, this is an interesting piece, y'all. This was 5.5% for the government bonds. You don't get that anymore these days, right? Like we get 0.5%, 1% if you're lucky, 1.5 if you're really lucky, or negative if you are in many European countries. So times are very, very different. And I think this is important aspect to pay attention to, that we're being pushed in very, very, very risky assets in order to be able to protect our wealth, in order to be able to grow our wealth. And I think that means that we have to get even smarter, because way back when you could put it in a bond, you could put it into your savings account, and you would get 5-10%. And yes, at the time when we're talking about this particular article, that there was an inflation of 10% and you were either even or slightly losing. But now you can have money in the savings account, and what do you get? Nothing. You don't get anything whatsoever. Let's continue. Uh, so, government bonds at that time paid 5.5% when inflation peaked at 10%. This means anyone who owned bonds in 1970s was losing more than 4% per year. So, roughly 4.5%. Let's be accurate. Depositors who held their savings in bank accounts lost money every year. That is still the case, very much the case, and it has been since the 70s. Economists call this condition negative real interest rates, meaning after adjusting for inflation, the rate of interest is actually negative. Most people don't think in real, they think in nominal terms. If your bank pays you 1% interest, but inflation is 3, that means purchasing power is savings lost 2% per year. That's the negative 2%. Now, we've already talked about this stuff. I already talk about all of that stuff on this channel all the time. For people to understand of what this actually means, you got to start thinking a little bit bigger picture. And you also have to take into consideration not just the interest rate and the savings rate and the inflation rate, but you got to pay attention to taxes as well, because taxes do impact you as well. So let's continue with the article because they talk about that as well. Now, this is the same situation we find ourselves today. Not exactly the same situation, but very similar situation, I would argue. Wells Fargo, for example, offers a way to save savings account that pays a whopping 0.1% interest. You're never going to save up enough on tenth of a percent interest, y'all. Now, interest from your bank account is taxable. So this 1% that you end up saving, y'all, it ends up being taxable. They take out the taxes, and guess what? You are left with around maybe 0.08% interest. Now, this is just the savings plus the taxes. Now we got to add inflation. Let's add it. Now, annual rate of inflation for 2019 was 2.3%. So this means that a depositor with Wells Fargo savings is actually losing 1.5% per year. Now, the interesting piece is that they're using 2% rate of 2.3% rate of inflation. There was an actual like a CPI reported kind of thing, but they tweaked that and lie with it and manipulate it to make it sort of flirt with the 2%. Sorry, y'all. Oh, allergies are killing me. So 2%, right? But then we have shadowstats.com, and you can definitely check out their website where they're calling and saying inflation it has been for years ah, sorry, between 6 and 8%. If you take that into account, well, you're not losing 1.5%, you are losing 5 to 7% annually. Now, that is a huge loss. Now, in this article, if we were to continue to read it, which we won't, but if we were to continue to read it, actually, we will. They're talking about gold and how gold has an ability to protect you. And I agree, but I think we have a different solution as well that I'm going to talk about now. Now, I do want to cover just a couple of things in here. Given that the U.S. national debt has increased by more than $1.2 trillion just since the beginning of May, and Federal Reserve has expanded its balance sheet by nearly $3 trillion since the start of pandemic. So we're talking March, April, May, June. So 3.5, 4 months is what we're talking about. Now, they're talking about the importance of putting your money into the gold, and I absolutely agree. And in the instance, it should not be uh, paper. It should be physical and probably diversify within it. Now, here is the part where cryptocurrency has a great way to help us potentially make money and save money at a much higher rate. Enter the world of decentralized finance, also known as DeFi. And DeFi allows us to convert our fiat into stable coins like a USDC or DAI or Tether or that kind of stuff. Now, personally, not a financial advice, but personally, I do like DAI a bit better than Tether, just because Tether is centralized and controlled, and they have been minting it or printing it or however I want to call it like crazy, which makes me feel a bit nervous about holding them. But to each their own. DAI is a truly decentralized component of it, but it fluctuates a bit more because it is decentralized. So, anyways, let's take a look. Now, if I was to have convert DAI USDC or one to one to dollar. Now, it's not 100% one to one. It might sort of flirt, especially on DAI. It might go like 0.98 one day to 0.1 one day. So it does fluctuate a little bit because, again, it's decentralized. And so it sort of buys and burns coins to keep rate to keep up with the dollar. But if I was to actually switch it one for one, more or less, I can actually put DAI in some of these decentralized exchanges and be able to collect a cool, anywhere from 0.62% on compound all the way to 2 3 almost 4% with the different networks, and that is by actually taking my coins and then lending it. Another piece that you also might be very interesting to learn, and so this is the part where decentralized finance is very exciting for me, that I can actually do this stuff because I can stake the coins, lend it out. They're still protected because of the collateral, and I am earning my money in these savings accounts. The traditional banking, when you put money the way that it normally would work, now it's much more advanced and much more, shall we call it crooked at times. But in a normal banking component, you put in money in the savings account. Bank basically takes the sort of uses that as a collateral, lends it to somebody else, and makes money on the other side of it, and then pays you a portion of it. Decentralized finance kind of does that, except takes the banks out of the whole thing and uses math and algorithms and protocols to make all of that work. So Compound or Comp is a decentralized coin that allows some of these things to kind of happen where you can make money by staking, by holding it, sort of like savings, right? Similar to that. And here's an interesting article with which we are going to end, and that is that now you can earn Comp by learning about it on Coinbase. People have been trying to figure out, how do I buy it? And here is an easy way where you don't have to buy it. You can earn it. Then you can put it in decentralized finance for saving it and start actually making money by saving it, right? Another way to sort of save up a little bit. Coinbase Customers can now earn Compound's governance token by watching lessons and completing quizzes about the money market protocol on exchange's educational platform, Coinbase Earn. Now, this ERC20 token, if you don't know what that is, make sure right after this you go and look it up. It's important to know that. It's important to understand what that means. The ERC20 token gives holders the power to participate in debates and decision making regarding changes to the Compound protocol. Token began trading on Uniswap on June 15th. A few days later, Coinbase announced that it would list the token. In the days after Comp began trading, its price soared from around $18.50 to nearly $360 on June 21st. And since June 21st, it has fallen back down and it's about 220 to 240, somewhere around there that is trading. So that's an interesting piece to pay attention to. So there you have it. If you are kind of curious about some of the additional pieces and how do you benefit from cryptocurrencies, how do you get yourself protected in this world, in this environment, we are offering Crypto 101 course. It's absolutely free as of right now. That is not going to stay free for forever, but right now that we are recording this live, and it is June 26th, it is free. So if you're interested, simply go to onedealaway.com and look for Crypto 101. Sign up for it. It's absolutely free. You'll learn a whole lot more about cryptos, different projects, how you can evaluate, how you can actually get into this market safely so that you can benefit from all of these changes. Because traditional finance, in my personal and humble opinion, is dying and it will go away from the way that we know it. It will transform, and I believe that decentralized finance is the new way that finance is going to work and is going to work for ordinary humans like you and I. Again, make sure you come back tomorrow at 7 a.m. If you're watching YouTube, smash the like button right now if you haven't already. Subscribe to the channel, and I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal